You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Hope you've been doing well. I thought I would mention that in case this sound of music cannot be scrubbed from the podcast, it is because my neighbors, who we absolutely adore, are blasting some music, which I'm quite enjoying, actually. You know, since it's a Friday evening, and that's what you should be doing, out on the deck, listening to some great music and barbecuing or something. So I just thought I'd mention it in case it can't be taken out of the podcast. So today's question is, do all whole life policies work for infinite banking? Is this a myth or not a myth? Okay, so this is partially true. There's certainly a specific way that we are building these policies. There's specific structure for these policies when you're starting off for IBC. However, can you bank with all whole life policies? So long as they have a loan provision, you should absolutely be able to bank with any whole life policy. You can even bank under your mattress if you really want to, or you could use a CD at any bank you want to do your banking. And that's because the infinite banking concept is a process, not a product. So even though you could use either of these things that I'm jokingly saying, kind of, the best product for the infinite banking concept is, of course, a dividend-paying, participating whole life policy with a mutual company. That will be the best vehicle. So the reason I say you can bank under your mattress or using a CD is because, again, you really should be focused on the process, not necessarily the product that you're using. Most people, once they start learning this, start getting really excited about being able to borrow against their policy while the full gross cash value continues to earn on a guaranteed basis, even the value of dollars that you've just borrowed against. And with the mutual company, you will continue to earn dividends as well. People get excited about this, the uninterrupted compounding of interest and dividends. And this is very exciting. It's really part of the magic of IBC and partly what makes it so powerful. However, where the power truly comes from is your actions. Treating yourself like an honest banker and not stealing the peas. And this means when you use some of your money, whether you are borrowing against a whole life account or not, you should account for what you've used by paying yourself back. You should pay yourself back at an interest rate greater than what's being charged to you. So if you are storing your money within a dividend-paying, participating whole life insurance policy, and the insurance company is charging you, say, 4 to 5% to borrow the money, maybe you should charge yourself 10%, 8%, 10%, 12%. The action of treating yourself and your money in the same way you would any bank loan will allow you to reap the benefits instead of the bank. It is very normal, and we are all conditioned to make monthly payments on our loans or credit cards. But when it comes to paying ourselves back for money taken or borrowed, the immediate mindset is, but that's my money. Why should I have to pay myself back? And why do I have to pay interest on my own money? Why would I do that? When it's my money, I should be able to take it and use it without any interest. So why are we willing to pay banks interest, but not ourselves? We will only end up with more if we do the same thing for ourselves. And what's wrong with paying ourselves monthly, just like we would any other loan? When it comes to repaying a life insurance loan, the company can only accept the amount that you borrowed, plus the interest that they are charging. They can only accept funds for 3 different reasons. You are either paying the policy premium, paying back the loan for the funds that you borrowed, or paying the interest on the loan that they are charging you for borrowing that money. So if they are charging 4% and you want to repay yourself at 8% or 10%, the policy will not be able to absorb those extra funds, that extra interest that you want to send back to yourself. This is where a separate bank account would be helpful, one that you use to keep track of your accounting for your banking system. You may already have a second bank account that you can use, or you may want to open an account for this purpose just to keep track of your accounting and make this process a lot easier for you. By doing this, then if you decide to take a loan for a certain amount and you want to pay yourself at a higher rate than the insurance company is charging, you can. What we could do is, I'm always happy to help you come up with an amortization schedule or build one for you with the time frame that you want to repay your loan and the amount you're comfortable or the interest rate, and letting you know what that payment would be. And then once you do that, you will make those payments to your separate bank account, your secondary bank account. And then from there, we can have the insurance company draft the loan repayment each month, or you could pay it differently. You don't have to have it drafted each month. You might instead choose to send money back to the company on a quarterly basis or semi-annual basis, or whenever you darn well please, just send the money in. You aren't obligated to send it in on a monthly basis or have a draft set up or anything like that. You are in full control. Though I always suggest paying it monthly or having the company draft it monthly, because that will keep you accountable to making sure you're putting the payment in. And also, every time that payment gets paid back to the insurance company, it goes 100% to principal, like I've mentioned before. So it's paying down your loan with the insurance company as efficiently as it possibly could. And it's also accruing less interest because your principal is coming down by your full payment amount. And then the interest that is being charged going forward will be on a lower amount because you just paid some towards the principal. So I always suggest just have the company draft it monthly. We can have it set up from your second account. There's some more detail maybe around this, but that's basically what I'm letting people know. And that way you're also paying the loan down with the company. But you have full control. You don't have to do that. You could let it accumulate in that separate account. And then you could send money back to the company whenever you're ready, whenever you want. You can send it in through the website, or we can call it in and you can send it over the phone. You have some options and you are definitely in control. You are in control of your payment amount, how frequently you repay, if you need to pause your repayments or pay it off all at once. The choice is completely yours. So, what will end up happening if you decide to pay yourself back at a higher interest rate than the company's charging, per Nelson Nash's teachings, his book, his suggestion? What will end up happening is that you will pay off the loan to the insurance company sooner. So, for example, if you set up a loan for, say, you want to pay 10% over a 5-year time period and you have a certain payment that you're paying yourself monthly to your segregated account, you will end up, and then if you're having that money drafted from that account to the insurance company will end up getting paid off sooner than 5 years. It won't take that long because you're sending in more money than required because of your higher interest rate. But remember, the company can only absorb and take back the 4% that they are charging. So you'll end up paying it off sooner. Let's just say it takes you 4.5 years to pay off the loan instead of 5 because you were paying yourself at a higher interest rate. But of course, since you're an honest banker, you're going to continue according to your amortization schedule, paying your loan back for the full 5 years. So you're going to end up sending that payment to your segregated account, and it's going to accumulate those funds because you can't send them back to the insurance company. You can't continue sending that loan money back. And so you're going to end up accumulating that amount of funds to be used for premium in the future, whether it's premium towards a paid up additions premium. Maybe it helps you in 1 year where funds are tight or funds are low. You can use that money to help fund the premium. Or maybe it's time to open a second policy, maybe on a spouse, maybe on a child, maybe on yourself. Ultimately, the way that you will grow your banking system when using a whole life policy for IBC, it is by growing your premium dollars. Funding more in premium will grow your cash value. It's very simple. Funding more in premium, now you have more money that's earning that guaranteed interest and also dividends. And so it just makes your pool of cash larger. And because you can only put so much money, so much paid up additions into a policy before it would become a modified endowment contract or taxable, you would have to open a second contract if you want to continue funding at the same level that you have been, or if you have that extra money from your loan repayments, you would have to open another contract. Since you can't fund it as high as you may want to, and you will have to decrease your premiums in the future, The only way to grow your system is going to be to open that second contract, third contract, fourth contract. Maybe you'll get to 10. I know people who have more than that. So at least if you're wanting to grow the system and you have no more place to put the money that you've already been paying into the contract because the paid up additions have to be dropped off in that and at some future point, that would be a good time to start a second contract. Of course, another good time to open a second contract is simply when your income increases, or your business does super well, or you just have extra funds from an inheritance or a tax return, and you foresee being able to maintain a certain premium level going forward. Then it may be time to open a second. So, anyhow, I definitely got off track here, but these actions are what's behind the true power of IBC, repaying your loans with interest. And these same actions could be done with another vehicle if you wanted. However, because your dollars continue to earn uninterrupted compounding interest, even when you borrow against your cash value, and because a participating whole life policy also pays dividends, it makes a whole life policy the best vehicle. Can you use any whole life policy? Well, yes, although I'm really referring mostly to aged policies. If you've had a traditionally built whole life policy for decades that does not have a paid up additions rider, I wouldn't automatically swoop in and say, that needs to be replaced. Let's get rid of it because it is well seasoned already, and most likely you can borrow against that contract. However, when starting this process, you are going to want a properly designed contract for the infinite banking concept, or you will have little to no cash value available year one, and your cash value account will grow very slowly over the beginning years. So, if you're just starting off, of course, we want to build the contract in the right way and the best way for your cash to grow, if that's one of your primary goals, which it usually is. But an aged contract doesn't mean it can't be used, the cash value that's already been built up in there. And we can always run an in-force illustration and compare them and all that just to see if it makes sense to keep it or if it makes sense to replace it. Usually I would err on the side of keeping it if it's an older policy, just because you've had that much more time for the growth and the compounding to accumulate those extra years. We can't get the time back. So it just depends. Usually that would be the case, or that's my first thought, but doesn't mean that it makes sense in every situation. So does any policy with a loan provision work? Also, yes, I think in general, although I can't blanket statement for all whole life policies, it's pretty safe to say that you could borrow against any whole life policy. And although all policies could work, they may not all be optimal. So we just have to take a look. Also, these older contracts may have higher loan rates because they were created in a different time period, and those different insurance companies change their rates according to what's going on in the economy. Of course, they're very slow to react, so a lot of times it takes them a few years before they're changing rates based on what's been going on, and then by then it may be changing again, but they are very slow to react. If you have one of these older contracts and you're also starting a new contract that you want to be built this certain way, we can always loop it in, take a look at their loan rules and all that, and loop it into your plan for what you're going to be borrowing against. Or I could help you figure that out if that's something that you have and want to be able to utilize. The only other thing that you have to be careful not to consider to be a permanent or whole life policy is a universal life policy. I hear people all the time mentioning and talking about how these are permanent policies. That's how they refer to them. As I mentioned before, these policies do have lots of bells and whistles to make them very attractive, and these policies can be illustrated at higher rates than whole life because the percentages can be manipulated. However, they come with maximum guaranteed costs that protect the company rather than guaranteed cash value that protects you. And even if the company doesn't raise rates to the maximum allowable rate that will be stated in your contract, the cost will still go up internally as you age because you're getting older. The cost of the death benefit gets higher, and that extra premium needed will come from your cash value. Is it possible to borrow against a universal life policy? Absolutely. Again, as long as there's a loan provision. But those loans generally do work different, and those contracts don't pay dividends. For the purposes of the infinite banking concept, I would steer clear of these index universal life policies, which have grown in popularity a lot in the recent years alongside IBC. And now agents are out there saying they will help you with IBC, but they're using IULs, Index Universal Life. And so that's not legit, honestly. Those policies are being built on shaky ground, not a solid foundation like whole life. In fact, I used to have IULs myself and have since terminated all 6 of my contracts once I understood better how they worked internally and once I discovered the power of IBC and whole life. Now, if you feel you are seeing the power of these contracts and how the infinite banking concept could improve your financial life, and you would like to get started and partner with a knowledgeable IBC practitioner and advisor, please feel free to reach out to me. You can reach me at Valerie@alphaomegawealth.com. Thanks so much again for listening, and as always, I hope you have a great week. Take care.